Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. Lee Meekcoms of Parkbridge Capital Group. Before we dive in, I want to ask a real quick favor. Would you mind taking an extra 30 seconds to head over to iTunes and rate this podcast with 5 stars? This gets us more listeners, and it means the absolute world to me. So thank you for making my day with that review of the show. All right, let's dive in. Lee has more than 30 years of experience in real estate. He initially entered the real estate investing arena in the apartment and self-storage sectors with a private equity firm based in the Northwest. He later formed Parkbridge as an affiliate company in the mobile home park and RV resort investment business. Lee's company was instrumental in the affiliate growing to over 60 communities across 13 states and 28,000 home sites. Lee participated in the first CMBS financing in the US in the early 1990s, resulting in $106 million in financing for his affiliate company. Lee currently resides in Los Angeles, California. Lee, welcome to the show.
Thank you, Andrew.
Excited to have you here and would love to hear your story and how in the world you ended up in mobile home parks.
Okay, good question. As I said, as you mentioned in the intro, I was in the apartment syndication business many years ago when I was a younger guy, of course. And during the business cycle, as things were tightening up, we had a spike in interest rates, and business slowdown. This affected the real estate industry, the multifamily industry quite dramatically. And I was living in the Portland area. We had a bunch of apartments up and down I-5, Eugene, Salem, Portland, Vancouver, and so forth. And noticed there was quite a bit of vacancy coming up in some of the apartments, particularly one bedrooms. People were consolidating, moving into 2 bedrooms, moving home with their parents and so forth. But while this was going on, I noticed the mobile home park industry in the Portland area. And Portland, the West Coast, Oregon has some really spectacular mobile home parks, some of the really nicest in the country. I noted that the 55 and older parks had like no change. I mean, they were full, people were paying their rents, nobody's complaining, people had fixed incomes, retirement income, owned their homes, whatever. And so with that noted and noticing the turmoil in the multifamily area, we also had some self-storage as well. And even that got a little bit shaken up. This isn't so much the case today, but nonetheless, what I saw in the mobile home park side with this stability and what appear to be predictable increases because of the lack of supply of spaces, I got into that business, picked up my first park was a 72 space, 55 and older property in Northeast Portland area. And very nice, picked up another one after that. And they ran beautifully for without a hitch, as if they were immune to the economy. You know, where you say where you hear the saying that mobile home parks are recession proof. Well, that was very evident to me. I was living it. While some of the apartments were going through a lot of turmoil, these were cruising along. And so that's how I got into the business originally.
Wow. And what time frame was that when you first got into the business?
When I was like a kid, I was like 5 years old. This was back in around 1982 or 3. So that's when the interest rates spiked up into the 20% area, you know.
Wow.
And that was for people that lived through that time, which, you know, there are many still. That was, the Reagan era came on and so forth, and we saw some turnaround in the business scene. But, you know, that's when I think Paul Volcker jabbed up the interest rates and stopped that recession, the inflation that we had in its tracks. In the meantime, you know, people suffered through that sort of inflationary spike and then had it cut short. Don't know what they're going to do today. It's a little bit more out of hand. But in any event, that's the time frame that occurred in.
Wow, that's wonderful. And I would love to spend a little time talking about that because it they say history repeats itself. Don't know if the Fed really has the gumption to do what Paul did back then and raise rates as high as he did. What do you think about the economy right now and, where interest rates are going to go? I mean, I've heard a quarter of a point, but I think it needs more than that. I don't know. What do you think?
Yeah, it's really hard to predict. I mean, this is not so much a credit cycle where you have this inflation. It's just from trillions of dollars being thrown out into the market, people having all the extra money. The problem is now, how do you squeeze that out of the economy? So it's analogous, I think, more to the Japanese inflation that happened many, many years ago, and then run a more dramatic program to run it out. I don't know what they're going to do here because the leadership is way different than it was back then. The appetite for the executive branch to take responsibility for what's going on and take the necessary actions to correct it or improve life for Americans seems to be beyond the reach of what they're willing to do. And so the future is somewhat unpredictable, even with respect to the business cycle, let alone whatever else is going on in the world, which is, certainly really tumultuous and hard to predict what's going on in the future. I would think that the interest rates do need to go up significantly in order to ramp down the inflation that we're having, but I don't know that's going to solve gas prices at all, or food. I mean, those things are just, in my opinion, been dramatically mismanaged with the resources we have available in this country. And so we're just kind of off to the rodeo, seeing what happens.
Yeah, it was funny. This past weekend, I subscribed to a newsletter by John Malden. He's an economist, and his headline of his email, he called recession. He said the Fed, is walking a tightrope, and he just doesn't see a way for them to get out of this without a recession. Do you agree with him?
I do. And you might even be looking at stagflation as well. We have a business slowdown and increasing prices at the same time, no increase in productivity. So, you people in small businesses today are having a heck of a time hiring. I mean, if you're in the business, you know how difficult it is to hire skilled people that actually even want to work.
Yeah.
So we have it's sort of a unique time in memory of those of us that have been through this sort of thing before. And yeah, time will tell how it comes out the other side.
Maybe you could shed some light on, mobile home parks. You mentioned how your 55 and older communities, they did well during the 80s, right? And
yeah, they sure did.
They performed well. How about, other recessions? I know there was the chattel loan crisis in the 90s. Yep. Right. Maybe you could shed some light on that. And then, even as recent as the Great Recession, right? In 2008 and 2009. Maybe
the greatest.
Yeah.
Which is the greatest recession. So, yeah, I mean, we had it hit the fan again in the 90s, I think, when we had a change in the tax laws. Bob Packwood, who was a U.S. senator from Oregon, changed the tax laws were voted so that passive losses couldn't flow through to investors anymore, and which created a huge problem for lenders. And so we went into a recessionary environment then, and frankly, that was the banking collapse that we had at that time, and the RT's Resolution Trust Corporation came along and consolidated a bunch of the banks and so forth. It was also very painful. We had a number of loans going through. I was affiliated with another significant investment firm, Ellenberg Capital. Some of the people who have been on this podcast may remember them, but we assembled probably the largest, highest quality institutional portfolio of parks in the country during the, let's say, late 80s to late 90s. But so, yes, that collapse the RTC entered in on was really painful. Not so much in the operations side, but the fact that banks couldn't really get loans. Interestingly enough, during this time, as the banks were going down, certain investment firms, Merrill Lynch and other companies that were doing white papers, were checking to see what was going on with respect to the debt of various types of assets. And what was discovered is that among these portfolios, let's say for Home Savings, Gibraltar, some of the CalFed, some of these other bigger companies, their mobile home portfolios were performing really well. which was a real eye opener to the investment community, as some of the other asset types had suffered pretty badly. I remember Lincoln National Life Insurance came over to our office, and we were interviewed for a white paper they were doing to assess whether they wanted to get into that business as well. As a result of those investigations back in the 90s, it was more or less proved out that the risk factors that were associated with lenders going into the mobile home park space were very low. And the foreclosures, the defaults were very low. So even though there was tumult in the markets, these assets were still performing very well, which led thereafter to a way out of getting out of this lending bind. And although there had been many REMICs, real estate mortgage investment certificate pass-throughs that were residential for years, we got into one where the first commercial REMICs were done, or CMBS loans, and my firm arranged it so that we were going to do a project where Daiwa Securities was going to lead through to do a CMBS loan. It was the first CMBS loan ever done in the United States in 1991. And the portfolios that were put together then were not multifamily. It was mostly, the greater part of it was mobile home park, our portfolio. Wow. So that was an interesting piece of history. And, the CMBS financing has become a lot simpler since then. That was a real wild and crazy time. But we came out the other end with our financing. And then from there on out, the CMBS market expanded by leaps and bounds to a whole really viable way of doing business, and gave an outlet to mobile home park investors. We really didn't have Fannie Freddie going strong at that time. And so when the savings and loan shut down, it was very hard to finance. Your seller carried paper would be the option. And then CMBS, conduits came out, and voila, we have liquidity and a lot more of that sort of business going on today.
Wow.
History.
Yeah, I can only imagine. Yeah, that's fantastic. The story of, I'm sure it was more common practice, right? With mom and pops being willing to hold paper, and just because of the marketplace.
That's true. So. That is true. And then shortly thereafter, you had some of the REITs coming out, and they were tremendously liquid, could pay cash. And that also, so following the tumult of the debt markets at that time with the RTC, shortly thereafter, you had the REITs coming forward. And then even more so into the mid-90s, and they were a dramatic influence in the markets, ELS and Sun particularly.
Sure. I wrote a note here when you were talking. I said, which institutional quality assets do you wish you still own today? Given cap rates are at the the lowest they've been on mobile home parks. I think I heard someone say in 50 or 60 years. Which ones do you think you wish you kept?
Yeah, I know. I mean, I haven't been able to make the paradigm shift in my mind, going from buying high-end 5-star assets at 8 3/4, 8.8 caps to where now it's less than half of that. But for instance, we had a beautiful couple of parks in Sarasota in the mid-90s that were divided by I-75, and total of like about 980 sites between the two. And we paid, I think, about $28,000 a site for those. Now, this, again, was like in the mid-90s. Those properties were bought, I think, a year or two ago by another company David Knapp put together using, I forget the name of but he has a big investment fund, and the name escapes me. That park was bought 2 years ago, and he paid, I think, $170,000 a space for it. So would we like to kept that? Probably, but hindsight is always 20/20. And, as an investment group, you like to make your investors happy and turn a profit once in a while. There are those guys that are very long-term holders. And I know someone that's, a great business, and you get to run the, inflationary spiral that way. I mean, I bought a property for my family back then in '88, a mobile home park in Portland, Oregon. I think we paid $22,000 a space. And I was sort of sweating bullets for paying that kind of a price for it at the time. And now that property is, it's not no part of my family. It's my former family, let's say. But that property is worth probably $125,000 a space. So, the Portland Metro higher quality parks, family or otherwise, or senior, are really priced up there, as you would see in many other areas. Yeah, so that's what happens. It's the asset you would rather not sell, that's the,
Yeah.
choices you make. But hindsight is remarkable.
Yeah. What does Sam Zell says? He says, you never get in trouble taking a profit, or you never,
That's true enough.
yeah, I mean, it makes sense. Well, let's dive in here. I have a couple other questions I wanted to ask you. What was the biggest hurdle for you, in your investment experience with mobile home parks? I mean, it seems like you were dealing with 55 and older, institutional quality assets. I'm sure management's a lot easier on those type of assets, but maybe you could shed some light on the toughest hurdle for you guys in the business.
Well, for me, since I was on the acquisition side, more or less asset management, I didn't get too terribly involved with the operational side of it. But, I knew we had operational issues in some parks, but those are, I think the operational issues, if you run across a portfolio, are endemic to anything you own. If you own enough of it, you're going to run into some really crappy things. For the most part, we were buying higher quality properties, but that didn't mean to say that inadvertently, one of the properties along a river wasn't going to get flooded out and be wiped out, or another one, we didn't own anything really in the tornado belt, but, we did, there were parks that were near us that were destroyed that way. Those are sort of extraneously, if you own that portfolio, it's your own private black swan event, let's say. But it's just the operating parks is just something that's really, really hands-on. You got to stay on it. You have really good people. We had really good people in our company to run those assets. And since that time, I opened up my own management company with my partner, Dora Steed, who used to be division president at Hometown. So she's very experienced. So I rely upon other people that really know what they're doing that way. My side of it was mostly, trying to figure out what to buy next and having it make sense and overseeing the due diligence properly. It's never been too much of an issue getting good financing, sort of an issue, but it's whether or not they're going to retrade you at some point, what that's going to do to your investors and just your sleepless night for a couple of nights or whatever. But for me, it was just, finding the correct asset, valuing it out, and being able to buy it. Of course, it's very competitive today. I think it's really, there's never been like a cornucopia of parks you go, I like that one or that one, and let's go buy those. It's always been, dig in, find them, evaluate them properly. And I'm really orthodox in the way I underwrite parks and really, have been, where you don't want to say tweak it. Oh yeah, we'll be able to save that amount on our maintenance because the broker said so, and they're paying way more. They're paying way more to the management you need to pay. And by the way, what happened to your reserves and replacements in there, Mr. Broker? And you just don't see that. But if you run a property, my focus is really underwriting the expenses much more than the income. The income you can play with a little bit more dramatically, and you can change things through marketing or what have you. Some cases not as easy as others, but you really get hit on the expense side.
Let's talk about the expenses, right? They say the industry standard is around a 35 to 40% expense ratio, and a lot of operators use that. Would you say that's true from your experience?
It's on a really case-by-case basis. In some states you have a much higher cost of your gross income goes to real estate taxes, for example, depending on whether you pick up the water and sewer inside of your rent or not, can influence that dramatically, by 5, 10, 12%. The age of the property can also influence the amount you have to spend on fixing it up, repairs and maintenance and so forth. If you're not catching your CapEx well, you don't know that your underground's going to have significant problems. You could, have issues there. But so it's really interesting. But I think that is probably a relatively good range, But see, when we underwrite, we also have put out a professional management fee. I'll use a CapEx reserve, capital replacements, and that sort of thing. And also when we have a real business that we have to abide by the laws. So we pay our on-site managers, and we also have to pay, their employees. We have to withhold on them. They have to pay workers' comp, all that stuff. Can't just really, at the size of properties we deal with, we can't just go, well, we'll pay under the table, this and that. We just don't do that. You can do it, just we don't do it. And it works. But so each to his own. I'm judgmental about it. Sometimes I wish we could, actually, but we don't. So overall, but saying if you're in the 35 to 40% range, 35 to 45, you see stuff come out, only 18% expenses, only 20. Well, it's falling apart. Of course, there's no expenses. Nobody's managing it. You don't do any repairs or maintenance. Really easy to run, low expense park. Well, why don't we find out why that is?
Yeah.
So you find that going forward that, I look at it very seriously because my money and my investors' money, I certainly don't want to lose my money, but I feel we don't want to, investors' money, that's way important than mine.
I feel the same way.
Sleep at night if I lose mine. My wife might be happy about it, but do not want to deal with investor losses. Unfortunately, I haven't had to, but nonetheless, those are all components of how you correctly underwrite and figure out expenses. And I think one of the great things that's overlooked is the CapEx. Capital
Let's talk about that. Let's talk about that for a second. What's an appropriate baseline, kind of middle of the road park CapEx reserve that you would say on a per lot basis you should be setting aside?
That's a good question. I don't know if there's any particularly spectacular correct answer to that. A lot has to do with the age of the property and what type of infrastructure you have. Let's say if you have on-site sewage facilities, whether it's a plant or whether you have septic, you could run into some major issues with that, as opposed to if you've got, public water and sewer, you might have a pipe break here and there, or maybe a root goes through a sewer pipe or the water line breaks, what have you. So you have certain stuff going on there. And then on the age, on the roads, and do an assessment of that. But frankly, I run probably 1.5% to 2.5% of gross, really fills in there, and that could be, I don't know, on the low end, maybe 75 up to 125, 150 a site, depending on the property. But it varies so much, but you can't, I don't think you necessarily fool yourself into thinking that's not going to happen. You could try and fool yourself that way as an underwriter, as a buyer. And it's certainly different when you're a lender, taking a look at the conditions and go, we're going to have you set aside your CapEx reserve at 25 or 30 or $50 a year. And I go, okay, great. That's great for the underwriting of the debt. And many lenders don't even require it. But realistically, I've been involved in overseeing and being involved with like 35,000 spaces. So over that period of time, you get a good flavor of what things are going to be happening to you. And not everyone goes into the tank that way. But if you have to replace a septic field, or you have Florida sinkholes, or eventually you can have to overlay your roads, all sorts of things can happen underground. You just run into that stuff. So yeah, I personally can't ignore it. Would like to, because it makes it, you can then come up with a different net operating income to which you can capitalize and buy whatever your preferred cap rate is today. And to compete in this market, it's pretty tough. I know you have the cap rate dartboard, I think starts at 3 and goes up to 6, and that's all you can play anymore in many of these better quality parks or different markets. And that paradigm shift has been made by some people pretty deeply. I saw a great park come on the market by a great broker the other day, John Grant, and it was up in Santa Maria north of here between San Luis Obispo and Santa Barbara. That's 3 cap. So, that's happening. Whether it sells at that or not, don't know, but highly desirable assets in California coast that are spectacular will sell for very low cap rates. You see this continually, So when does that go back the other? I keep asking, when do the cap rates start moving up again? And They usually do follow interest rates to some degree, but interest rates have only gone down X amount. Let's say debt goes down from 4.5 rate down to a 3.5 rate, but cap rates have gone down from about a 5.5 to a 3.5, or a 6 to a 3. That's a big spread. So you lose a lot of your cash flow, and so I guess it depends on what your investors are satisfied taking these days. And those guys that have investors that take 5%. I know some very good companies are paying 5 or maybe 4. I don't know. And then mine's a little bit more than that. But it's a problem. But now we run into this craziness today. I can't call it craziness, just the way things it is the paradigm shift where we have very low cap rates and debt rates going up. And you have your cost to do a deal. By the time you run your cash flow diagram, I mean, your net cash flow per year can be, not where you'd like to see it. And now in the days of inflation, sorry to keep running off here, but the inflation.
I want to talk about that because I think that's one of the big things when I talk to our investors that they're concerned about is, you're going in, right? You're buying this asset at this cap rate and you're planning a 5 or a 10-year hold and then, an exit cap rate,
Sure.
And now today we don't really know, right, what that exit cap rate is going to be, right? Because it's heavily dependent on what interest rates are. So what have you seen in the past, and have you bought assets, whether mobile home parks or apartments or storage, in a rising interest rate environment, and how did that play out?
That's a good question. I really haven't quantified it, but we have bought parks over the years in rising interest rate environments, which would be rising cap rate environments, and I think that's just going to be that's something that never seems to change. You have some fluctuation in rates, although interest rates are so contrived these days in a way. I mean, look at what's happening to our debt. Realistically, if you had to run up and stop things by raising the real cost of money to beat inflation, let's say, or raise the cost of money, the government debt is so dramatic that a 1 or 2% increase in the what's paid for debt for U.S. government securities, there's nothing left but to pay the debt. So it's fairly manipulated, it appears. But we seem to be everybody's in on the game. But as far as forecasting in and out, you could assume that, well, if I'm buying at this rate, certainly I should sell at that rate. Maybe I'll sell it a half a point higher because rates will move up. But that's sort of dependent upon each individual sponsor, let's say each managing partner,
sure,
or the committee or the asset management group that's going to determine how that works out. It's just a guess, really.
Sure. We talked a little bit about expenses. Maybe we could talk a little bit about, the revenue piece. What is a consistent in the primary markets, let's say, rent growth wise, what have you guys seen over the, 30 years you've been doing this for rent growth? What's a realistic percentage? Everybody says, oh, you could raise rents 5% per year, or, as inflation gets higher, oh, you can always just raise your rates with inflation. Is that realistic, or what, where are we off there?
Yeah, I think you're going to have to choose your poison. I think because you can only run it up so much. In some markets that are really tight, you can really jam the rents, let's say, really push them up high, but you can, in many instances, create a backlash and have some regulatory authority weigh in on you. For instance, Oregon never had rent control. It was not allowed to be put in a local level. And a couple of years ago, the state decided to go with very, somebody comes in and says, we're all our tenants are eating, Alpo lately, and you can't really even buy a good hot dog anymore, that sort of thing. So, and we'll cry before the legislature, and bingo, you've got rent control. It's not really an accurate assessment of what's really going on, because most people are living an affordable lifestyle without the rent control. And then when you get rent control, it makes it even worse. But to answer your question, I think you can trend with inflation at least, and have to maybe add a little bit more than that. And if you manage well, or the business is in a market that has really high demand, certainly go above that. And in many cases, you can take once in a while a more dramatic rent increase. Well, look, this part we could forecast 3, 4, or 5%. Of course, rent inflation now realistic, close to 9 or 10 when you weigh everything in. Can you project that? Perhaps. I mean, it's easy to take a park that's in a $600 rent market, but the rents are $500. It can certainly take a much larger increase than a 3 to 5% increase initially, bump it up, and then run up from there. But it's so interesting because so much of this business, because of the way it's stratified, and there's no really concentration of a great number of parks in a given area, that the rents can be all over the place, and you just have to judge that. We've been really careful not to, make it really painful for our customers. At the same time, we serve two publics, the investor and the tenant. So trying to be fair to everybody and want to make the tenant's experience where they live a great one. I want people that go into parks that we're involved and go, this is a nice park, rather than go, God, look at that crappy place. Who would live there? Because we invest back in the property in the long run. That pays back very good dividends, as opposed to neglecting it, taking all in cash flow today. You can do it, but you're better to invest back into it, reap the value in the long run.
Yeah, and I think that's a lot of the people we're buying these parks from, at least with my firm. They somewhat have let these things go, and they don't realize that if they would have reinvested into these things, it would have paid them threefold at the closing table, instead of kind of taking all the cash and not reinvesting. So
exactly, so that is exactly the case. And but some people are squeezed. They want the cash flow, or they don't care. They don't care so much about the tenants. Oh, they're just rent or whatever, But I think you really have to take care of your tenants. You have to provide them a nice environment which to live. And the other side of it, so they would then have more pride in what they own. And then, people look at the assets. So I'm happy to have people take a look at it. Go, I'm glad I own that. I bought parks where people would go, wow, that's recently, let's say, a disaster. I go, yeah, but I know what we can do with that. I bought a park here about in 2018 or 19, 18, I think it was. Not a big park, but it was falling apart, horrible tenancy. I was able to remove a lot of the tenants because at the time we still were able to do that. It was in Oregon. And so we replaced probably 80% of the tenants, moved in new homes. So this was an RV park, not a mobile home park. And, 3.5 years later, sold it at a 4 multiple and a 42 IRR. You can't do that every time, but I don't even like to say it because, I want to do some business with you. You're getting 42 IRR. No, that was probably an anomaly. But the fact is that, if you can go in and see, it sounds like this is what you do. If you see an opportunity of something that's really mismanaged, a lot of deferred maintenance, people don't know what they're doing. They're not spending money in the right places. They don't know to, throw some good money at the landscaping, which is probably the easiest way to increase the curb appeal and the look of your park, that on a nice sign, and then start forcing people to clean up or head out. And you got to get a really a nice story in the making for the tenants and you and your investors.
Definitely. Lee, let me ask you this. What are your thoughts? It seems like you're more of a primary market guy. What are your thoughts on secondary and tertiary markets and mobile home park investing in those?
Well, that's a good question. Years ago, we were very primary market oriented. We were building a large mobile home park portfolio. And we had great presence. Let's say we had 20 parks in Florida, rather large ones with 10,000 spaces. Some had golf courses and elegant clubhouses and so forth. Same in Arizona, some of the biggest and best RV parks in the country and around the Phoenix metro area that now were sold off to owned by one of our investor partners at the time, Cal Properties. It's really, really nice stuff. But so those were very institutional. Nowadays, I'm actually not so much primary market driven because I'm trying to get better returns. So we'll look at secondary and tertiary markets in order to get those returns. I just haven't been able to make that paradigm shift yet to buy the 4 caps. I haven't had anybody come to me and go, I'd like to buy a 4 cap park. And let's invest and do that. I guess we could. There's plenty of guys out there that have, whether they're individual high net worth players or, hedge funds and sovereign funds and so forth, and go ahead and do that, even REIT. So I'm not there,
Sure.
Where do I want to be, actually?
I'm with you. Yeah, I'm not there either.
But yeah, I like secondary markets. I like tertiary markets that I think we're seeing in this day and age because of people's frustration with what's going on in some of the big cities, that they like to get out of town. and they like to live in a smaller market with their family and their kids, I think that's a great choice. You just have to, whether you choose one that's solely oriented in one industry, or if you get one that has a few different industries, that'd be great. I mean, you might find a tertiary market that's all, military, let's say. It can work great, unless they close the base down. It's like the popsicle factory in Maine. When they close down, well, nobody's left to work or live there anymore. But no, I'm all in on that. You just have to judge which market you want to go in on.
Definitely. Let me ask you this. What are the most important things passive investors, we're talking limited partners here, what do they need to look out for when investing into the mobile home park asset class?
Well, that's a very good question. The investors that I have, and many of them are people I've known for years, friends of mine, high net worth people, and I literally want them to know as much as they can about that asset and, know about it and so forth. You can leave it up to me and people will invest with you and I because they have confidence in what we do. But I love people to know all they can about it. So know the guy you're investing with. If somebody's going to invest with you, you're become quite prominent, well known. You have a bit of a track record going. You're a young guy. You could be whatever your dreams are, you're likely to achieve over your lifetime, doing it methodically. For me, still, we're doing some investing now and then. What I want to make sure my investors are frankly a bit picky. So, and I can afford to be. So I don't want to go, I really got to get in a park. And if it doesn't work out right, you're going to harangue you. You have enough uninterrupted non-8-hour nights of sleep as it is without an investor joining in on that too. You know what I mean? So I want to make sure my folks are well informed. Have been invested in real estate before. It's not to say I'm taking people in that's kind of new to the game, but like to help them out. But ordinarily, I want people to know a lot about it. And if they can study and read, listen to podcasts, what you do. There's a couple other industry guys. Well, Frank and Dave have their thing. I tell people, go to Frank and Dave. Go to their MH University, whatever it is. I sent my wife and I will be married, I think, 6 years this coming. This weekend. Holy cow. I'll be right back. But anyway, so she wanted to get involved in the business. And so I had to go to Mobile Home University. It happened to be in Austin. I didn't want to go. I wanted to go to a brisket safari. So it worked for both of us at that time. And she'd said, well, do you know about that? Oh, yeah, I do know about that. How about, I know about that. What about, I know about that. But I'm glad that people are learning that sort of thing. A lot of people in this business have gone there and getting really well educated. I think it's money really well spent, to read books about it, follow blogs. There's all sorts of interesting things you can get involved with to raise your level of understanding. Because, the more knowledge you have about something, the more responsibility you can take for what you're doing and have a certain degree of control in that too. So, sort of knowledge, responsibility, and control kind of go together. And I think that's, sort of important. Not sort of, but really, really important.
Really important. Lee, let me ask you this. When studying a new market to go into and to invest in, what's one metric, if you had to narrow it down to one, that is most important for you?
For that, I would say demand for affordable housing in the area, I think, is really kind of key.
And how would someone find that out? Would they, how would someone find that out?
I think you just see whether the apartment supply, how that's going, where the housing supply is really jumping in terms of its pricing and so forth. You can look into vacancy rates in other parks in that area. And it's really hard to narrow it down to one metric because that can really mess you up a little bit. But I'd like to see a bit of a diversified base and know that area is growing somewhat. But you can be in an area that's not necessarily growing, but has a real stable, ongoing flow of people that want affordable housing, whether it happens to be military, whether it happens to be a chemical plant or whatever. Oil and gas is something I've stayed away from. I've always been a little bit reluctant to get into an area that has major swings regarding the business cycle, depending on whatever industry. But so diversified economy is great too. So to answer your question, one metric, hard to say, but I think the demand for affordable housing, seeing what apartment prices are doing, how occupied all those are, and then, whether people's ability to be able to, buy homes in the market or whatever. So there are a lot of things that go into it. It's not, this business has become more complicated than it used to be, I believe, because years ago, if you're buying a mobile home park or a manufactured home community, you can go into a community and would find that there are a couple of dealers in town. A park had a handful of vacancies. You'd find them placing homes in the park, and they would sell. Nowadays, a lot of those street dealers are gone. And if you're going to get in and fill a park, you have to do some arrangement to bring the homes in yourself, which adds a whole different layer of risk. You have to have a skill set for marketing, or really, really understand the demand, or see that maybe somebody else next door is doing it. You go, well, I can see I can do that too, because they're buying his houses and selling them for, 50 to 75 to 80,000 a piece. When the other houses in that particular park might be selling for 20. So that's sort of an unnerving thing. Would you gamble that? So you have, these are all various assessments you have to make. And that has actually made this business, I think, a little bit more hard to wade through than it was many years ago.
Agreed. What does the perfect mobile home park look like in your eyes, and why?
Ooh, I think it would be in Bali, for starters, I think. Near the beach.
Yeah.
But why? So the perfect mobile home park, if money were no object, we can all have our dream park, but I would be in an area that wasn't rent controlled and wasn't going to be looking toward getting rent control, that had been 20 years or newer, that's on public utilities, underground infrastructure in good shape, roads are in good shape, that sort of thing, with pretty high demand, and it would be in a good market. Could be in its primary market, and of course primary is a whole different level of perception. We're dealing in mobile home parks as opposed to like Class A institutional investments for sovereign funds, which would go to LA, Washington, D.C., New York, Boston, and San Francisco, maybe Chicago. All different when we're dealing with mobile home parks. Phoenix would be great. Let's say Portland, go to different parts, Denver, those are, or Orlando, Naples, Fort Lauderdale, all great markets. Wouldn't mind owning them. You do run the risk in some of those markets in Florida. I lived in Florida for 14 years, and it was more than one time that a hurricane had my home as a bullseye, so that's unnerving. But those are risks you have to take. So I think, just as I said, it's got to be a quality asset, diverse economy, 20 years or newer. If you had your druthers, 10 years or newer, all double wide homes or all single wides, that people had really, really kept it up. You see the pride of ownership in it with good on-site management. On-site management is a whole nother thing. That is your life as an owner operator, whether you sleep well or not. It's whether you have good on-site management or whether it's a rodeo as well there,
You're so right. Last question, park-owned homes, tenant-owned homes.
Help me out. I'm not a big park-owned home guy. I've been involved with parks that had a few, or we manage third-party managed mobile home parks, and dealing with park-owned homes, I've seen it where you can have a little spread on the rate to make an X amount of dollars at the end of a year or two. Whenever they move out, you can spend all that money fixing it back up for the next person to trash. That's not necessarily true with the newer homes, and some of that can work out really, really well for people. Where you're doing like the single-family build-to-rent stuff is a big deal in the market today. Can work very, very well if you're buying mobile homes or manufactured homes. George Allen would have me to say mobile home, but manufactured homes, putting them in and renting them out, good maintenance program, good management can be really, really wonderful. Older homes get into all sorts of problems. These homes do get abused. It can be hard to fix them up. For me, I limit, if I'm looking at a park, we limit at 10% to park-owned homes or less, preferably zero.
Yeah.
But for other people, it's like, well, great, let's bring them on. I can get all that extra cash flow. That's the choice to make,
I think people underestimate the costs to renovate a mobile home.
Yeah.
I think they forget or don't realize that like the drywall's a different size, the doors are different size, the windows are different sized, and typically have to be special ordered and shipped in, which right now with the logistical issues raises the price significantly. So
Sounds like you've had some experience with that.
oh, unfortunately.
Yeah, it's a real, you got to really massage that. It's a real skill. And guys can do that really well. It's just that, I've chosen not to.
Yeah. It can be difficult. Lee, how can our listeners get a hold of you if they would like to do so?
Stop on by. I'll be around. I can be reached at my email address, lee@parkbridgecapital.com, LEE at park, like where you walk, bridge, like over the water, bridge over the water, capital with an AL at the end, at parkbridgecapital.com. Probably the easiest way to do it.
Lee, it's been an absolute pleasure. Thank you so much for coming on the show.
I've really enjoyed it. It's been great. Thanks for having invited me.
That's it for today, folks. Thank you all so much for tuning in.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021, and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.